Good day, everyone. My name is Rebecca Lilly for the International Association for Energy Economics. It gives me great pleasure to welcome you to today's webinar entitled Climate Risks and Corporate Carbon Strategies. We are grateful to our moderator, Lynn Zhang, and our distinguished panelists for today's timely discussion. First, a little bit about the International Association for Energy Economics. We are the largest association specializing in the field of energy economics and provide a forum for the exchange of ideas, experience, and issues among professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations along with a host of other products and services that you can find at our website at www.iaee.org. If you're not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our moderator. First, this webinar is being recorded for those that cannot participate in today's live event. If you have questions for the panelists, please click the Q&A button at the bottom of the Zoom window and type your question. We have allocated time at the end of the webinar to read and answer them. And now I would like to introduce you to our moderator, Dr. Lynn Zhang, Assistant Professor at the School of Energy and Environment at the City University of Hong Kong. Lynn, over to you.
Thank you, Rebecca. So please allow me to share the screen first. Okay, thank you very much. Thank you for attending today's webinar. So it's also a very, thank you so much for IAE to giving us the opportunity to give this topic on climate risk and corporate carbon strategy. And in today's webinar, we will talk about the climate risk. Actually, the climate risk includes both the physical risk and transitional risk. Physical risk actually is kind of assessment of how a climate and weather-related issues that could impact the business operations and the supply chain in general. The climate change risk, or say climate risk, including companies that needs to confront with, including both a physical risk and transition risk. Physical risk usually refers to the natural disasters such as the drought and floods, and the transitional risk we refer to risk related to the regulatory changes from the government perspectives and legal issues, reputational and comparative risk that's associated with the climate change mitigation. So if you look at this figure, it shows that actually the physical risk is quite high, and the impact of the climate change on the agricultural sector and also in the regional GDP actually increased significantly. It shows that total economic cost for global climate-related disasters in the over 20 years period increased by 150%. So that's a huge cost for the economy and for those climate sensitive sectors as well. And also this leads us to think about the possible asset stranding. So this is related to the transition risk, because with more increasingly stringent of this environmental regulation over different countries across regions, and we will see both the countries and the firms, they are facing a lot of regulations, policies in order to reduce the emissions. And this will lead to that one type of the assets related to fossil fuels becomes useless or valueless. And this is a critical issue to be discussed for academics and for business sectors and policymakers to think about. And again, the climate risk is reputational, because it will change the kind of relationship between the business and climate, and changing in particular changing the stakeholders' concerns about the environment is quite critical to affect the bilateral relationship between the business and climate. And as a responsible business leaders, they only want to do a good thing for the climate for 2 reasons: because they think this is a good thing to do, right? And the second is because they think this will be able to attract the high-performing talent and new clients and capital. Why? Because actually the generation, mostly the younger generation, they have a relatively higher concern of the environment compared to the older generations. So that's kind of this generation shift actually drives the society or the whole economy towards a more responsible way from the environmental perspectives. But actually, although many many organizations and firms, they started to think about the climate change, business leaders, they still are not very clear about the negative impact of their operations on the environment. And they can only consider this when the industry or the business are deeply connected to the environment issues. For example, the software company definitely will not take into account the risk compared to those firms in the oil and gas industry, right? So how we need to force or how we need to persuade those business sectors to do this thing. We need to think about how to change the mindset of those stakeholders or the key business leaders. And we know that climate change is threatens the financial resilience. It will cause the banks direct loss from the extreme weather, the disasters, and will also create the future liabilities for financial firms and for their clients. So this will significantly increase the financial risk of those in the financial sectors, and then this will spill over to the other sectors of the economy. And to do that, we have to think about how to assess the climate risk, right? So the first step is to think about how to incorporate or integrate the climate or environmental related risk into the supervision of the central bank or into those top authorities. But this has a lot of challenges, including the problem of the data issues, how to correctly quantify this risk, and how to translate this risk from those models into more useful information or indicators for the financial decision makings. And also because nowadays there's a very limited disclosure of this climate related risk or those related to environmental performance of the firms. More than 70% of the world harvest emitting companies, they did not show off their full risk in their 2020 disclosures. And we also see about 20% of the audits shows no evidence of risk assessment. So for example, when the BP is one of the companies, as example, that's wrote off billions of dollars in 2020 as a result of lowering long-term oil price assumptions. So, and also we required a significant improvement of the climate change law. Without the proper climate accounting, the money needed to fund the transition to a green economy could end up in the wrong place. We definitely need the government to take steps into these directions. Okay, so in today's webinar, we are honored to invite two speakers to talk about the climate risk and the corporate carbon strategies. Our first speaker is Professor Zhang Dayong. Dayong is a professor of financial economics at Southern University of Financial and Economics. His research interest covers energy finance, climate finance, general economics, financial issues in emerging economies. He's the co-founder of the China Energy Financial Network, president of the Society for the Studies of Climate Finance in China, and vice president of the International Society for Energy Transition Studies. And today he will share his opinion and discuss the role of the government in affecting corporate action against climate change. Okay, Dayong, the floor is yours.
Okay, thank you. Let me share my screen first. Okay, thank you very much, Lin, for inviting me to this IE webinar on climate risks and corporate carbon strategies. I think this is a very, very important topic. Climate change has been around the world, and we all experience different kind of challenges across the world. And our teams has been working on this climate risk and related topics for a number of years. And I think there's a lot of things to be discussed, both from academic point of view, and also there are kind of important policy relevance topics that need to be addressed. So before I start then, and I will give you a little bit of background information about, I think Lin has provided a very solid introduction of what's going on around the world and what the business sector is facing in against the climate change. Well, this is some of these updated data here, some updated information for global mean surface temperature. So we're all talking about global warming. How serious is global warming? And obviously this number is on the left panel here is the global picture of mean temperature in 2021, last year. As you can see that the anomaly, or this is anomaly, that is the temperature relative to what happens in between 1981 and 2010. And you can see this in certain areas. So the average temperature anomalies can go up to 5 to 10 degrees Celsius. And if you look at the overall trend, so, and you can see this global warming is obviously the speed of temperature increase has been faster in the last few decades. And in 2021, the most recent data from the World Meteorological Organization is the global mean surface temperature was 1.1 degrees Celsius above the pre-industrial baseline. What does this mean? And if you refer to the recent Paris agreements, the Paris Accord, so the agreements targeting 2 degrees Celsius by the end of this century. So we're controlling the temperatures increase within 2 degrees Celsius relative to pre-industrial level. And that leads to a lot of actions like carbon neutral commitments across the world. And of course, you can see it's only 20 years, we're more than halfway towards the target. So that's what the IPCC recent report is talking about. Climate change is faster than what we expected. It is happening, and it's happening much faster than we expected. It demands a kind of more aggressive movements across the world. And of course, some may argue, what does global warming actually bring to us, right? So it's kind of a very simple idea. Global warming means the melting of ice in the North Pole, and then leads to the rise of the sea level. And in 2021, last year, global mean sea level reached a new record high. And also there's kind of a normal precipitation across the world. And you can see it, for example, in China. In the last year, we observed a number of very serious floods across the country. And it's not alone in Europe as well, and of course, other places in the world. So the natural disasters has happened more frequently as a consequence of global warming, and it's more devastating across the world. Now, some of the numbers may give you a better idea of what has been happening around the world in the last few decades. So between 1970 and 1979, the number of reported disasters was only 700, but what happened in the last 2 decades is about 3,000. And more importantly, the economic losses is enormous. Right? So the total economic loss is 3.6 trillion, but where the last decades, the number is 1.38 trillion US dollars due to these natural disasters. And more importantly, if you ask people what's going on in the next 10 years, now this is what the World Economic Forums, they have this global risk report every year. In this year, the top 10 global risks ranking, you can see clearly the top 3 are all related to climate. And the first one is climate action failure. The second, extreme weather, and the third is biodiversity losses. And if you count for the number 7 and number 8, out of the top 10 global risks, 5 of them are related to environmental problems or related to climate changes. And that's what we are facing. It's become very risky, and climate change or climate-related risks is becoming more severe over the next, now and over the next 10 years. And this is what Lin was really mentioning. Climate risk. It's not only about So when we talk about climate risk, it's not only about a physical risk, so that is like the nature disasters, right? So more frequent, more severe nature disasters happening in the last decades and will happen in the future, right? Droughts, heat waves, wildfires, floods, etc. But there's also kind of other risks, perhaps more serious, and it's difficult to measure and difficult to value. This is a transition risk, right? It's the policies that we take to cope with the physical risk, to cope with climate change, right? It's the new technology that we need, climate policy shapes and consumer preferences. And all this together will lead to the increase of risk across the society. They will generate direct economic losses because the loss of infrastructure and other economic losses related to this risk. And also, like transition risks will lead into stranded assets, something I mentioned earlier, is like the devaluation of the carbon holdings and other things, oil, gas industries, etc. And it's overall, we can see this climate risk, both physical risk and transition risk will change the playground fundamentally. That will lead to significant movements around the world. So for example, some of the central banks, like the Feds and the European central banks, they all take climate risk into consideration when they look at the systemic risk in the banking systems or in the monetary systems. So climate risk can affect the whole economy. So look at the governments, right? So they can affect the race matters, and they can also affect households through changing the attitudes, right? So people may have low carbon preferences, or they consume, they change their lifestyles, in recognizing the threat of climate change. Right. But more importantly, what we are trying to look at today is the impacts on firms, because in the end of the day, whether it's governments or the household, coping against climate change or reduce carbon emissions, it depends on the actions of these firms, because essentially are those firms that generate emissions, and their actions against all these emissions will eventually lead to the government to achieve the carbon neutral goals or any other kind of climate targets. Right. So that's why there's kind of a growing interest to look at the impacts of climate risk on firms' behavior, and also how do we make the firm be more responsible to the climate change. In the literature, there are already a huge amount of works related to nature disasters, something that way before we understand the climate risk, people investigating the negative impacts, the economic impacts of nature disasters. And of course, it's easy to understand these nature disasters will hurt, will destroy infrastructures, will cause firms, therefore it will affect the financial performance of the enterprises, and it will change their financing decisions. But if you add additional things in, like the transitional risk in recent years, especially when more government has committed to deal with climate change, and they introduce a lot of policies, like for example, emission trading, carbon pricing, all right, or other kind of climate financing mechanisms to support climate change actions. And that gives the firms more, gives us a more interesting question to study how firms respond to this transitional risk. We're probably easier to understand the firm's action against the physical risk, but then it's also very interesting to say how the firm responds to the transition risk. All right. So there's obviously an increasing attention in the literature to study climate risk and its impacts on firms. And more interestingly, in the literature has shifted from studying physical risk to transition risk, although how to define transition risk is still under a lot of questions. And of course, in the end of the day, when we see if the firms are responsible or their climate actions is responsible to achieve the general climate targets, then it's kind of interesting for studies to investigate how to incentivize firms to engage in climate actions, right? So Lee was talking about reputational issues or preferences, like individuals in the young generation are more concerned about climate change. But if you look at firms, when you think about how to decide an investment decision or how to make their operational changes, it is not only about their personal preferences or kind of reputational changes. There must be something more complicated to incentivize firms to engage in climate actions and to cope with the threat of climate change or climate risk. And this is what we are interested in general. So what we are trying to do, what I'm going to do in the next few minutes is trying to explain, use a couple of examples of our recent work to explain how firms may react to certain, especially when we look at the transition risk, how firms will respond to policies and how do they respond strategically, and how much that's going to affect the effectiveness of climate policy. And then we look at the role of governance. Now, the first question I'm going to briefly talk about it is the real effects of transition risk, the real effects of climate policy. So in particular, because we were thinking that because of the policy uncertainties, the biggest challenge of the climate risk, apart from the physical risk, is this policy uncertainties. Right? There's kind of a racing interest in the literature talking about economic policy uncertainty, and also we are interested in climate policy uncertainties, and that's type of the transition risk that we're interested in. So there's a recent work in the Journal of Financial Economics by Bartram, and they were talking about the US as a case, and they look at the implementation of the ETS, the emission trading systems in the state of California, and how much that's going to affect firms' decisions to operate in the state of California. So the idea is very simple, and in the end, what we found is the implementation of ETS actually moves some of the firms' production outside of the state. So firm does react to the policies, but reacting to the policies actually leading to unwanted policy outcomes. So in the sense that climate policy or transition risk does have a real effects in the economy. So what we are doing, so in one of the recent working papers, we have done a similar works, but we look at international level. So we look at the implementation of ETS across countries and how that may affect cross-border merger and acquisition decisions of firms. We know that cross-border merger and acquisition is an important investment decision made by firms. And it's very important international capital flows for multinational companies. Okay, and what we do find is the idea is pretty simple, because the implementation of ETS is considered as a climate policy, kind of climate policy, and the policy is a signal of further more stringent climate policy, and it will be considered a kind of transition risk, right? It first of all will introduce additional cost, extra cost to the firms to invest in a country with ETS. And also, because of the uncertainties of climate policy in the future, it creates a risk channel that leads to uncertainties for the firms going into a country with ETS. All right, and then it leads to the idea is if the multinational corporations observe the country implement the ETS, they will tend to relocate their investment or try to avoid that country. And that's just a simple idea that follows this kind of logic. I'm not going to explain the more details about the empirical findings, and we do find significant evidence of the firms relocate their investment or trying to avoid that. But this graph here for the EU in particular could possibly give a more intuitive idea. So this is kind of, we look at the merger and acquisition cases for entering EU. We know that EU has this emission trading, it's the first emission trading system. That's operational from 2005, all right? And one may argue that it's going through several stages, and to be, in 2005, it's not entirely mature, but it's a signal. It's not only the ETS itself, but also it's kind of signal of policy uncertainties in the system. It is very interesting to look at the most two dominating sectors that going through cross-border merger and acquisition into EU market. Before 2005, manufacturing is the biggest sector, and service is the second, right? And the things changed completely after 2005. And obviously you can think about it, manufacturing industries because it's more carbon intensive, therefore it's more affected by ETS. And whereas service industry is less affected. So in a sense, the structural changes over here is just a kind of intuitive signal that firms does make some strategic changes in response to these policy uncertainties. Okay, and of course there are other kind of empirical evidence I'm not going to illustrate over here. Now we know that firms firms is essentially a profit maximization entity. So what they're going to do is they're going to try to maximize their profit, right? And if you want to make sure the firms does react to climate policy or trying to do something favorable to climate, you're going to have to provide some kind of incentives. And reputational or personal preferences may be useful, but we say governance we need a stronger, more formal kind of mechanism to make sure the firms react properly to the climate policies. And here that we want to talk about the role of governance of firms' climate actions. And here we talk about governance as kind of mechanisms that trying to avoid agency costs and trying to make sure the firms, the managers react towards the interests of the stakeholders. All right. So here we talk about external governance and internal governance. And then one of the literature in finance called Law and Finance, promoted by Laporta in the 2 papers in the 1970s and 1990s. And then basically talking about civil laws and common laws, whereas common laws system, they pay more attention to shareholders' interests, and civil law system pay attention to more general stakeholders' interest. And therefore, we could think about this, if you talk about carbon strategies or emissions, and if these firms are more caring about the shareholders' interests, they are more profit-oriented. And if the firms are carrying more broader stakeholders' interest, then they might more towards green. So civil law system and this logic will tend to increase firms' green actions. All right, so that's the general idea. And of course, there's all arguments that the level of governance, the efficiency of the government, corruption, or other things that can reinforce the role of climate policy. So because if the government set out policy, the enforcement of that policy matters. Okay, and of course, there are also typical internal governance, like the typical idea of the genders or age or other things that may affect the firm's operations. Okay, so those are the things that we are interested in. And how does these kind of factors affect firms' behavior? All right, so we did a analysis, this paper published last year. So we look at a number, over 1,000 firms, international firms, and we look at how much renewable energy they use and how much this renewable energy use as a green behavior related to governance. And we found a number of very interesting things. First of all, we do find governance matters, both internal and external governance matters. And more importantly, we show that the interaction effects exist between internal governance and external governance, in the sense that we think it's not only when you talk about a governance structure in the firms and how that may affect corporate behavior, carbon behavior, it is also very important to look at a more general, the institutional background in the country or the national governance or external governance in general, and that may affect the effectiveness of internal governance. All right, so some general things that I'm not going to repeat all this findings here is that, say for example, the female directors more favorable to environment friendly actions. Therefore, the firms with more female directors tend to use more renewable energy. All right, and we do also confirm that the civil law systems, firms in civil law systems and other things equal, they tend to use more renewable energy. And that's kind of evidence suggesting that the policymakers have to pay attention to all of these internal and external factors when they're trying to promote green behavior for the business sector. Okay, that's what we have found through of a couple of our example studies. And of course, there are a lot more. Given the time frames, I don't want to spend too much time on the details, but there are lots of things to investigate in these aspects. All right, the future research area on this area there's a lot more or enormous opportunities, right? So first of all, say for example, how to measure climate risk, all right? Like especially, it's probably easier to measure climate risk from the physical parts, right? So how many storms, how many floods happening, and what's the economic causes on that one. But it's probably difficult to understand how much kind of transitional risk is for a country or for a place. So it's a lot of work done that needed. And there are lacking of theoretical foundation to understand why corporate behave in this way. There's a lot of empirical evidence is building up, but theoretical foundation is entirely lacking. Right, so there are also needs to understand because the sample, because the information we get is from a very limited samples for the firms who report this through ESG disclosure, and so with more of ESG disclosure information available, then we should be able to have made a more clear structure or picture of what's going on there. And of course, there are many other climate policies across the world. The more countries take ETS. Introduce ETS in the system. There are climate finance, and then many issues that could lead to corporate behaviors that is worse for further investigation. And of course, like climate change governance and green innovation, because technology progress is another very important issue to study in the literature. Well, I think this is, given the time constraint, I think I'm roughly within 20 minutes, or hopefully it is. If this is a little bit rough, but in general, I want to see this idea of looking at climate risk and corporate behaviors, and also looking at the role of governance is a very important, it's a promising area for future research. I think that given, there's going to be a lot more work in the future that could lead to interesting results. In the end, I want to also a small advertisement that we launched a new journal called Journal of Climate Finance together with Elsevier. It will be online next month, 22nd of August. I think this is the first journal specialized in climate finance, and we encourage people from different disciplines to discuss this climate issue, climate finance issues from micro level, from macro level. So we do encourage people. We hope that we know that people are interested in their areas, and I hope that cumulatively we could generate better idea of what's going on here, and then hopefully bring a better future for the world. All right, thank you very much. I think that's all I want to talk about today. Pass to you, Lin.
Thank you, Dayong. It's very interesting talk, and it's very inspiring. In particular, you shared your research on internal and external governance. So if you, for the audience, if you have any questions, you can start to type in the Q&A, but I prefer to save all these questions towards the end of this webinar. So please allow me to introduce our second speaker. Our second speaker is Professor Zhong Huan. Huan is assistant professor in the National University of Singapore. She is interested in international finance, financial economics, especially the interactions with the government policy. Previously, she works in the Chinese University of Hong Kong and the University of York. And today, she will discuss, can Chinese climate policies reshape social responsible investing, and how? Huan, the floor is yours.
Thank you very much, Lin. Please allow me to share my slides. Okay, thank you very much for having me here. It's really a great pleasure. Today, I'm going to talk about how climate policy affects international sustainable investments. So just now, Dayong has talked about the climate risk and the transition risk. This paper seeks to tackle these issues from a different perspective. To transit to a net zero economy, substantially more investment are needed. Right now, we have already started many green products, but unfortunately, these green products are either too pricey or too preliminary, which lack of economy of scale to upgrade to the next level to meet the household demands. So say despite of the development of say, low carbon beef, it tastes not as good as the actual beef, but it's selling at a much higher price. This motivates a lot of households to purchase this type of goods, even if they are willing to support climate mitigation and adaptation. So to push up the production of green products to a scale that could attract sufficiently investment from the private sector, more needs to be invested. And if you relied on the public resources to finance the large-scale green infrastructure and the research and development of this green technology and green products, is far from sufficient. So to follow Gates' recent book, it's important to close the investment gap for the transition to net zero for the government to adopt different policies. It's not until the government leverage their policy tools to encourage this private investment to engage in the climate mitigation at a very early stage can we actually transit to the net zero in the short term. Or before mid-century. Studies so far have focused on how climate policy mitigate the climate risk, like either physical risk or transitional risk. So you see that these ETS or carbon tax are found to be effective in reducing emissions, and they are also effective in promoting green production, green innovation, among others. But little is known about how climate policy could affect the global allocation of sustainable investments. And the sustainable investments are very important because it finance green activities that mitigate climate change. So unlike financial investments, they prioritize financial returns. These sustainable investments are moral money. They prioritize the social welfare over the financial returns. So it doesn't mean that they don't pursue financial returns, but they have a higher priority in improving their social responsibility. So they incorporate this ESG and CSR into their investment decisions. So while searching for financial returns, they also seek to make an impact to improve the social welfare. So you probably come across these terms like socially responsible investing, impact investing. All these are referring to the sustainable investments. So by definition, you need to consider social benefits. And in particular, in the recent context, is mostly about carbon emissions into the investment decisions. So these investments, they seek to support climate-friendly activities. For example, the research and development of clean energy, and also the adoption and generations of renewable technology and carbon capture technology, or you can list it, they could benefit our adaptation and the mitigation of climate risk. So to pursue these social mandates, sustainable investments are different from traditional investments in the sense that they're willing to lower their investment returns, and they are also willing to endure longer investment horizons for green assets. So they have this green preference. So they are willing to sacrifice what they could have required if they were to invest in traditional way. So in this sense, the contribution of the sustainable investments are likely to accelerate the transition to the net zero. But little is known how sustainable investments are determined. So far, most of the study focus on the demand side. For example, how is the green bond price relative to the regular bonds? But the studies focus on the demand side of these green products is relatively scarce. So they usually extrapolate the sustainable investments without actually measuring the sustainable investment per se. And the evidence is usually limited to the US. But sustainable investments not just favor the green assets domestically, they are also invest globally for the green assets. So this is to support the global mitigation of climate risk. Given that the carbon emissions could easily spread over from one country to another, it's also necessary for the global investors to coordinate in one way or another. So I'm going to give an overview of sustainable investments before proceeding to analyze how climate policy affects sustainable investments global allocation. So if you look at this chart, this black line is representing a traditional investment, which is of course growing very fast, like many of the financial products are available in the market. If you look at this green line representing sustainable investment, it's also growing very fast, but it many pickups after the Paris Agreement, and it spiked in recent years as the climate activism strengthens. So if you look at the detailed statistics, in 2001, the sustainable investments are basically negligible. And the traditional investment is around 2.23 trillion, but it grows very fast to 24 trillion in 2021. In the meantime, sustainable investment has risen from almost nothing to 2 trillion. So if you calculate annual growth rate, the growth rate is as high as 83% compared to 26% for a traditional investment. So you see the gap is shrinking. The ratio of sustainable investment to the traditional investment also rise from 4% to 8%. So this is substantially increment in the penetration of the capital market by these sustainable investors, thanks to its faster growth rate. If you look at the distribution, in terms of the share of sustainable investments globally, you find that in countries they have adopted relatively stringent carbon regulations like the EU and the other areas, it tends to have a large share of sustainable assets under management. So usually when the market is relatively developed financially, it also has a larger share of financial assets under management. Sorry, sustainable assets under management. But if you look at the growth, you see even in small countries is picking up very fast in terms of sustainable asset growth. And this is because the baseline asset under management of the sustainable investors are relatively small to start with, but they are picking up very fast. So after having a broad sense of how sustainable investments allocate their capital globally, we can now proceed to understand what could possibly drive the sustainable investments. So we are interested in this climate policy because it deliver what sustainable investments are striving to achieve. In another word, climate policy actually mitigate climate risk and help adapt to climate change. So these studies, they have suggested carbon policies reduce emissions, sparking green innovations or promote consumption and generation of green energy. This provides evidence that if I invest in countries that have adopted climate policy, I could have a better chance to contribute to climate mitigation and adaptation. So this backs sustainable investments investment mandate and therefore attract their investment flows. Another possibility is that the climate policy could magnify the climate-related opportunities for sustainable investments, and this could potentially improve the returns or reduce risk. So many financial articles have come up with evidence that climate policy improves the valuation of green assets relative to traditional assets or brown assets. And studies also show that climate regulations are exposing these carbon-intensive firms to higher regulatory risk and transitional risk, and therefore reduce the risk of the carbon-light firms. So in another word, if you are investing sustainably by holding proportionally more green assets, climate policy would reduce the portfolio risk. So climate policy could actually reduce the investment risk for sustainable investments. So given this differential impact of climate policy on traditional and sustainable investments, we can argue that climate policy, they contribute to climate mitigation and adaptation, wouldn't have similar appeal to the traditional investments like it did for the sustainable investments. After all, traditional investments aim to maximize their return or minimize their risk. So the differential impacts of climate policy would enable us to do a causal identification. So using this difference in difference approach, we can then evaluate the impact of climate policy on sustainable investments. So here we basically use the traditional investment as a control group, as a benchmark to evaluate how the sustainable investment change before and after the introduction of climate policy. So we use data from various resources, and I'd like to highlight the three key variables that I'm going to use interchangeably later. The first is the asset under management growth. So this is picking up the growth rate in total asset under management. And I'm also interested in the new money going into a particular economy that have adopted climate policy. And I'm also exploring whether this sustainable investment return could actually be higher than the traditional investment returns, especially after the adoption of climate policy. Okay, so this is the baseline results. So using this DID, I find that the asset under management growth rate actually goes up significantly for the sustainable investment after the adoption of climate policy. Okay, and this is mainly driven by the new money flows into these economies. They have adopted the climate policy. It also the climate policy also contribute to drive up return, but this is relatively small compared to the role of new money flowing into these countries. So it provides evidence that climate policy does attract international sustainable investments. If you recall that this asset under management growth rate is actually a sum of the new money flows. Here, remember that this is normalized by the total asset under management, and return, which is the performance of sustainable investment return in our context. So out of this 50%, 0.50% increase in the growth rate, 77% is coming from the new money flow, and the rest of 23% is coming from the rising, improved sustainable investment returns. Okay, so if you visualize it, basically the asset under management growth rate is can be decomposed into a rising investment flows and improving investment returns. We further differentiate the announcement effect with the implementation effects. This is because investors are forward-looking. Usually before the announcement, upon the announcement of climate policy, investors have already factored in the potential impact on the portfolios. So they're acting preemptively, anticipating the forthcoming effect of climate policy. So for investment, it's very important that we take into account of this announcement effects. But previously, we have focused on the announcement, using announcement as a cutoff point. But implementation might introduce additional information. After all, there's a significant gap between announcement and implementation. In the case of China's national ETS, it was announced many years before its implementation last year. So we're interested in whether there's any differences between announcement and implementation effects. And here we show that the implementation effect is much stronger than the announcement effect consistently for the SM under management growth and the new money flows and investment performance. Okay, and this suggests that we should really look into this implementation effects in order to capture most of the information they are relevant for sustainable investments. But the fact that the announcement effect is significant and positive before the, even before the actual implementation of climate policy suggests that we need to take into account the announcement effects. Otherwise, it would lead to underestimation of the overall impact of climate policy if we only focus on the post-implementation periods. Okay, so to verify that this is actually driven by the climate policy, we show that the asset under management growth for the sustainable investments were barely changed, and before the announcement of climate policy. After the announcement of climate policy, the growth rate goes up steadily and then become statistically significant after 3 years. So it does take some time for the asset growth, for the sustainable investment to grow in response to the climate policy. And we show that this is mainly driven by the investment flows. So we observe similar patterns. Several years after the adoption of climate policy, we do see a significant rise in the investment flows, which is consistent with our baseline results. And this also indicate that, we are picking up this post-climate policy effects and instead of anything else. Otherwise, if other factors that drive our results, we should have observed change in either asset under management growth or investment flows before the adoption of climate policy. So this should ensure that our results are robust and in view of other confounding factors. So I'm going to quickly go through this two channels. One is the peculiar channels. People argue that socially responsible investors are doing good just to do well. So in this sense, we should observe that sustainable investments goes to countries that could bring them better returns. Okay. Another channel is that if they're truly pursuing this social welfare improvement, let's go for climate policy that contribute more to mitigate the climate risk. So in our context, it could be the physical risk or could be the transitional risk, which we measure by green innovation and renewable energy generations. So this is a quick illustration that the investment flows goes up more in countries that benefit more from the climate policy in terms of investment returns. But this is barely significant. And once we control for the investment return, the significance goes disappear. And this one is testing whether money is flowing, sustainable investment flows is going to countries they lower the investment risk more. And as you can see, it's actually negative, showing that this sustainable investment flows actually goes to countries they are exposed to greater financial risk. So this will becomes clear once we show the preliminary summary statistic that the sustainable investments are actually much more riskier than the traditional investment, and similarly generate much lower returns than the traditional investment returns. So this echoes with the preliminary observation that sustainable investments are not actually chasing returns or trying to minimize their risk. And then we test for the non-pecuniary channel. And here we observe that countries countries whose climate policy contribute more to reduce carbon emissions or improve renewable energy generations or green technology innovations receive more sustainable investment So this provides evidence in support of the non-pecuniary channels. So overall, we do find that climate policy has a positive impact on attracting sustainable investments. They are enhancing climate mitigation and adaptation. And we argue that this is mainly driven by the climate policy's role in reducing carbon emission other than affecting their financial asset valuations. So this calls for more careful design of climate policy in various aspects that could help attract the sustainable investments through, contributing to the climate mitigation and adaptation. Okay, I will stop here. Thanks.
Thank you, Guan. So that's a really good news. So you bring us a very good news about the climate policy to this induces sustainable investment. That's a really exciting on that. So now our Q&A session opens. So for all the audience, you can start to type in your questions. So we will start to answer some of these questions. Well, great. So we got 3 questions. Let me read. The first, I guess the first question is for Huan. So the question is how to define whether the investment is sustainable or not.
So that investor has a label stating whether they are considering ESG, CSR into the investment decisions. So if that is the case, then you would be counted as sustainable investment.
Great. I think the second, yeah, good. The second question is also the same. So I go to the third one. Is for Dayong. Considering the service sector does not emit CO2 the most, I'm confused about why does this sector become the most cross-border MA in the EU? Thank you.
Well, I think, thank you for asking this question. The general idea is when EU implement emission trading system that will bring additional cost for the sectors who emit carbon dioxide or even more carbon dioxide. And because the service sector does not emit CO2, they are less affected by the emission trading, whereas the manufacturing industry are more effective. So the number of investment or cross-border measuring positions in the manufacturing sectors falling down, and therefore service sector take the leading positions after the implementation of ETS. Well, I hope that explains the question.
Actually, I also have a question for you, Dayong. So you in your talk, you mentioned about the ETS. So actually, you are saying ETS induces a relocation of the international investment. So if this is true, then this probably will lead those firms to relocate from countries with stringent climate regulation to a country with less climate regulation. Then this is more like a carbon leakage, right? So if the emission moving from one country or one region to the other, then still we cannot mitigate the global warming. So since your talk is related to the internal governance, right? So from the internal governance perspective, could you give some suggestions that can potentially to prohibit this kind of carbon leakage?
Well, thank you. It's a big question. I think first of all, the issue, or for that paper in particular, so we look at a more from the external institutional environment. So ETS or other climate policy, we use ETS as a representative or an example of external environment or governance. The kind of climate policy that leads firms to relocate their assets, and this is particularly relevant to what has been discussed intensively recently in the EU to introduce the carbon carbon border adjustment mechanism. Right. So it's trying to avoid carbon leakage. That is, we somehow provide this kind of evidence that there are possible carbon leakages that are hurting the industries in the EU sector. So Well, I'm not supporting this carbon tariff from the EU, because that's going to create other troubles. But if you talk about, how whether we could use the internal governance, basically, you consider, if you look at this issue, we mentioned this carbon leakage across the whole world. And there's also carbon leakage that is applicable to a country, like what the GME paper were talking about, California's ETS. That would need some firms to move their production outside of California, that leading to carbon leakages. So to avoid something like that, there is the possibility that we could introduce a kind of say, for example, the ESG compulsory disclosure system. So it's trying to kind of providing incentives for the firms to react. It's like more than just from profit maximization perspectives, and then putting kind of responsible investment or sustainable investment into consideration. And of course, then if the market reward, because in the end of the day, the firms can get benefits from their production, and they can also get the reward from financial market. Like the investors recognize the importance of sustainable behavior, and then they will lower down the cost of capital, etc. So in that perspective, the firms could actually change their internal structure, making sure that decisions are, incentive compatible to the firm actually operational behavior.
Yeah, thank you.
All right.
So we've got another question from the audience. Sahid Barrow. So how to ensure that climate policy is effectively and efficiently enforced? I think this question probably is related to Huan, but also I think Dayong can also add some points.
Okay, so we use several measures. In the data provided by World Bank, they also report the revenues collected from the climate policy. So based on this, and also it reports the amount of carbon emissions covered, the share of carbon emissions covered. So based on this data, you could find out to what extent are the ETS or carbon tax regulate the overall carbon emissions. So you can check the intensity and stringency of the climate policy based on this data. And for results I haven't shown, I find that climate policies they has wider coverage and charge a higher price, which reflects more stringent practice in more stringent regulations are more effective in attracting sustainable investments. In another word, you need to show your credibility. So like many other policies, climate policy cannot be a window dressing. It needs to have real effect on economies in order to attract these sustainable investments. For the other questions, mostly about sustainable investments label. This so far is labeled by the investors. So the data provider record who consider ESG according to the self-claim by the investors. Okay, over to you, Dayong.
Well, okay. I think you provided good answers to that one already. But I want to just add a few points here. And well, this is related to what I was mentioning about this external governance, really, how effective national governance and how effectively the policies are enforced. That related to, it's like if you look at the world governance indicator, there are kind of 6 measures, like including corruption, government effectiveness, and law enforcement, etc. So those are the measures for a country. We do actually find evidence that those are important measures. But to ensure climate policy effectively and efficiently enforced, that requires not only just the governance, but also it takes some time. For example, even if you look at the EU case, the EU ETS. It's been introduced in 2005, but in the first 2 stages, there are a lot of troubles, right? The system was not really, because coping with climate change is something unprecedented, really something hasn't been seen in the past. So we can learn from the experience, but we also have to recognize the difference across countries. So for example, in China, when we have this, we introduced the nationwide ETS, we only focus on power sector, and it takes time for the market to react, because at the moment, although there's a national trading platform, the market is not entirely, the size of the market is relatively small. Liquidity has problems because there are many other issues, like how to calculate carbons, how to make sure everything's in right order. So the whole market design needs some time to actually make it, like we call the market infrastructure, the basic physical infrastructure, and also kind of governance infrastructure. That everything all these two together, they could possibly lead into the success of climate policy. So once again, that could possibly take some time.
Yeah, actually, I think another perspective for sustainable enforcement of the climate policy is that how to make sure the government can run or can design the policy in a more sustainable way. I don't know whether you heard about this. I heard a news that saying that Germany, actually, they are trying to withdraw the 2035 climate goal for the energy sector. Instead, what they aim is to reach the target after coal-fired energy plants are phased out, but there are actually no new date set for this in the draft legislation. And I guess this is kind of bad news for mitigating the climate change. And if other countries or other regions follow these steps, then there will be significant in terms of the climate policy at the worldwide levels. So I don't know whether I would like to hear about your opinions, both of the speakers. Huang, would you like to go first? And because if there's some change on the climate policy followed by other countries, right? So then this will definitely affect the sustainable investment, as you just mentioned, because climate policy induces sustainable investment. So this then again, this will bring us back to maybe in even higher dangerous situations in the later stage.
Okay, I'm going to talk about this from the finance perspective. View it from the sustainable investors' perspective. If you look at the accelerated growth in the past few years due to rising climate activism, the sustainable investments have driven down the asset pricing of this traditional sector, like oil, gas industries, are substantially low. So if you look at this price, despite the recent surge, the stock price of these brown assets are still surprisingly low historically. And it's time for them to go up a little bit. Right now, the carbon price is surprisingly low compared to the jump in the oil price. So firms, especially if they don't declare themselves to be socially responsible, they are motivated by financial returns after all. They're profit seeking after all. So as long as the carbon emission cost is lower than the actual benefit of oil prices, they will go for it. So if this oil price continue to be high, I would expect more and more recarbonization is going to happen.
Yeah. Okay.
Yeah, and then countries have different priorities and different risks. And now the energy crisis is definitely much bigger than the others.
Yeah, then we were facing another round of even severe physical climate risk and transition physical climate risk.
I mean, the sustainable, like climate change is not that imminent compared to the energy crisis. So people are typically short-term, they have this short-term bias. So we would expect policymakers, household and firms to, focus on short-term interest.
Yeah, Dayong, I know you are an expert in China's climate policy. I would like to know whether China probably will stick to its previous target for carbon neutrality by 2060, or probably China will revise its target following the actions of Germany. How do you think?
Well, well, thank you. Well, I think, well, China will, I think for sure China won't revise or drop that target, because this is something firmly determined. And obviously on the way towards this target, whether it's peaking the carbon emissions for in 2030 or achieve carbon neutral in 2060, it takes a lot of efforts. It's not going to be easy, in a sense that we're going to expect to see kind of, it's not like, say, we have a target and we reach there, it's just like a straight line. We draw a straight line. And we have to realize towards this target, it requires a lot of changes. It's like when look at the stock market, it's growing, but it's growing in a way that you have a fluctuation over time. So you're going to have to recognize the short-term shortage of energy. And that's what happened in the last year when we have a power shortage in many of the Chinese provinces. And therefore, we have to reuse some of the coal powers. It's similar to the German case. In the end of the day, we talk about sustainability. Sustainability is not only a long-term thing. People has to survive now, right? So short-term sustainability is still sustainability. So we have to balance the current needs and long-term goals. It does not necessarily mean Germany will drop the goal forever. They're going to have to achieve that, one day or another, because that's what the target is, and that's what the international society has agreed on. And the same to China. So basically, what we're saying here is we have an energy crisis. Is we have to make sure we have, like, for example, we have also seen the troubles or the challenges due to the coronavirus pandemics. And we have to recognize the difficulties and accept some kind of, short-term drawbacks, so short-term kind of turning points. But then long-termly, in the long run, we have to aim for it. But as I said, I have very firm beliefs in the Chinese government that we were going to go for it. And I think especially when we look at the target, is really, say, for example, when you look at the oil crisis at the moment, the oil price is pretty high. And of course, when you look at what Germany or the whole Europe is trying to do, and it will definitely move away from fossil fuel energy, because that's for long-term energy security that demands for such kind of movement, right? So that's what I think. In long term, I'm still quite positive, both in China and outside of China.
Yeah, thank you. Yeah, actually, I totally agree with you, in particular the point that you mentioned that we cannot sacrifice the need of humans for the sustainability. So that is not sustainability. We need to sacrifice our needs, right? So we have to fulfill our needs in order to achieve sustainability, I would say. Okay, so we are running out of time, and I guess we already answered all those questions from the audience. And now, thank you again for Huan and Dayong to sharing your excellent research, and also thank you all the participants with us for this excellent webinar. Rebecca, now I'm handing over back to you.
IAEE wishes to thank all of our outstanding speakers for a truly interesting webinar. This webinar will be available on IAEE's website for future download. If you're not already a member of IAEE, we encourage you to join by visiting www.iaee.org. We thank you for attending, and I officially close this webinar.